Now, do you need tax advantages like tax-free municipal bonds inside a pre-tax plan? No. Because income will be taxed according to the plan, not according to the investment, which will all be taxable when it's withdrawn. Assuming you plan properly, do you need liquidity inside a plan that you're not going to touch for 10, 20, 30 years from now, depending on your age? No, this is not the place for your liquid assets. But how about safety? Do you need safety? Well, sure, you need a certain degree of safety. But what kind of safety do you achieve when you place your money below the line? You get day-to-day safety, preservation of capital. That is, what's there today will be there tomorrow, as interest or dividends. However, short-term safety is not what's needed here. What you really need is long-term safety. What do I mean by that? The money you're putting away today needs to be there 20 years from now. And for it to have been safe, it has to have outpaced what? That's right, inflation. Historically, assets that keep pace with inflation or have the potential to exceed it have been found above the line. But long-term safety above the line looks kind of like this. This is my highly analytical graph of the stock market. Long-term, the stock market is where you look if you want to outpace inflation. But this kind of long-term safety above the line does not provide day-to-day safety. Values will move up and down. However, the more time you have to be invested, the less likely you are to lose value historically. Now, this is a good place to interject something. A very important principle. It's what I call the first rule of accumulation. And it goes like this. Take the free money. Where might you find free money on the pre-tax side? That's right, 401k. Within your company plans, you should generally contribute the amount necessary in order to get all that employer's matching dollars. So the key box in our map approach on the pre-tax side is in this area above the line. Now, if we only do what I've said, that is just to invest our money above the line on the pre-tax side, we have a problem, don't we? What's the problem? We're not vertically diversified anymore. And my first point was the importance of vertical diversification. Where do you think we're going to get that vertical diversification? That's right, the after-tax side. To help us achieve vertical diversification, we're going to take advantage of the after-tax side. On the after-tax side, we want to focus below the line. All of these attributes, safety, liquidity, and tax advantages, which have little or no value on the pre-tax side, would have a tremendous value on the after-tax side. Just as the aggressive box is the key to the pre-tax side, the safe box is the key to the after-tax side. Here, we want to build the foundation below the line with tools capable of providing tax-free income at retirement. Now, those tools are limited primarily to three. I already mentioned one. Do you remember what it was? That's right, tax-free municipal bonds. The second one is cash value life insurance. And the third is Roth IRA or Roth 401k. Each of this, if used properly and you can qualify, can provide future income that is tax-free. By structuring them correctly and following the rules, you can pull out tax-free future income streams from each one. Generally, if a person is at or near retirement, wanting a stream of income right away, we lean toward the municipal bonds. If a person has time to accumulate, is in good health, and especially if he has others counting on his income, like you, we utilize the cash value life insurance. While the Roth can be used in this box, it's actually more appropriate above the line in most cases. We don't typically use it here, and I'll show you where it belongs in just a minute. Now, what rates of return would you expect to receive from below the line vehicles? Long-term, historically speaking. 3, 4, 5%? Let's say 5% long-term. But if you're not paying taxes on this 5%, isn't that equivalent of 7 or 8%? Which means if the bank pays you 8%, after tax, it's basically 5%. Now, 7 or 8 certainly isn't bad. However, it's still not what people hope to get above the line. What do people hope for above the line? Sure, people hope to get 10, 12, 15, 100% above the line. But we're not trying to compare the returns of safe, conservative products with the returns of aggressive or risky ones. We are simply trying to ensure that for whatever percentage of our assets is held below the line, we are achieving as much return on our money as possible over the long term. So the safe box is the key box in the after-tax side. Now, many people do and should own after-tax assets above the line. One of the best tools available above the line is the Roth IRA or Roth 401k. We just saw how it could be used below the line if it needs to be. But because of the very long-term nature, we generally prefer to fund it with equity investments above the line. We just need to make sure we are accumulating sufficiently in the safe arena to permit the use of the Roth in the aggressive component. Another great tool is an employee stock purchase plan. For those who are fortunate enough to have one, this is another version of the first rule of accumulation. With the 401k match, it was take the free money. With the ESPP, it's take the discount. Aside from the Roth and ESPP, when it comes to the after-tax above the line component, we aren't looking for tax-free income as we were below the line, or free money through a stock discount. Here, we are looking for growth, pure and simple, with a secondary consideration of tax reduction through the use of long-term capital gains when applicable. In other words, the equity markets. For some people, that means the stock market. For others, the real estate market. It may be business ventures or gold and silver or variable insurance products. But the idea is to obtain that paper money growth and turn it into real wealth by systematically moving gains from the aggressive to the safe component. This is what I call the funnel approach. That is, funneling assets down from above the line to below the line over time. Perhaps the best systematic approach of accomplishing this objective is known as the annual asset reallocation. That is, once a year, you rebalance your overall assets to get back to your ideal asset mix. This causes you to buy when the market is low and sell when the market is high. The complete opposite of what most individual investors actually do. In other words, if your objective is 50% above the line and 50% below the line, when the market has done well, you might find yourself 60% above the line and 40% below, requiring you to sell up some profits to get back to 50-50. That is, sell high. It works just the opposite in a down market, when your annual asset reallocation causes you to buy low by moving assets upwards. It's a little tougher with real estate because of its inherent illiquidity. But it can be accomplished by funneling income from the asset rather than the asset itself. Does that make sense? Am I making it clear enough? Good. Now let's take a look at some proper macro asset allocation guidelines. That is, what to do with your money. Basically, we look at the total dollars that you have to work with. That is your total investable dollars. A basic approach is to divide it 50-50, left to right, on each side of the tax fence. That's a reasonable approach for many people. We don't know what's going to happen to tax rates in the future. We want to keep our balance so that we can lean one direction or the other, depending upon what transpires. While a 50-50 split is probably reasonable for many people, let me give you a couple of exceptions. First, someone who's making a whole lot of money and expects to maintain a high income in retirement. If you're making $400,000 now and want $300,000 in retirement, you probably don't want $150,000 coming out of that pre-tax side, because $150,000 is not a low income, and it's not likely to be taxed in a low tax bracket. It could even be taxed at a higher rate than it would be taxed today. So if you're concerned about that, you want to lean heavier on the after-tax side. Frankly, you'll actually end up that way anyways, because you can only invest so much on the pre-tax side. And if you're making that much money, hopefully you're investing a lot of it. So you might be more like 30% pre-tax and 70% after-tax. Conversely, if you have a household income of $30,000 and you're hoping to retire someday at $20,000, you will probably always be one of those in the lowest tax brackets every time. So you may still do what most of the national newspapers and magazines who are targeting Joe and Jane average are saying. That is, you could still